in following the global financial crisis and how policy was enacted then. So definitely take advantage of those questions. So with that said, welcome Stephanie to, I'm going to put in quotes, Gonzaga. We're going to start for those.
Thanks for having me. I'm really happy to be here.
Good. Sorry. For those students in here and some of the other faculty members and some parents, I believe, have joined us. Any question you guys have, how we're going to kind of do this is basically a Q&A. We have a couple of questions that I've gotten from students that I will ask. Ask Stephanie, Dr. Aaronson, and Stephanie. Ask her, and then if you have questions, feel free to chat them to me. You can put public, you can do it private, and then I will unmute you so you can then ask Stephanie those questions directly. So to give you a little bit of interaction with Stephanie. So with that said, the first question we have is very much what's going on with labor markets, right? We've had this coronavirus, this economic shutdown. What are you guys seeing kind of nationally and on the West Coast?
Yep. So I think we can just turn right to my first slide. One of the, best and kind of most up-to-date, why is this not changing? Okay, there we go. One of the most up-to-date statistics we have that summarizes what's going on with the labor market are people who are filing claims for unemployment insurance. And so this graph, it's actually crazy. It shows, this is just the number of people every week who file claims for unemployment insurance. And you can see that, for many months and years prior to now, the number has been in the hundreds of thousands each week. And even during the Great Recession, the number was like less than 1 million on a weekly basis. But in recent weeks, we've had literally millions of people applying for unemployment insurance claims every week. So this just shows, and it was just very sudden. It was like 6 weeks ago, there were about 200,000 people filing for claims every week. And then all of a sudden it shot up to like 3 million, then 6 million. It's come down a little bit now, but it's still around 4 million people who filed for unemployment insurance a couple of weeks ago. So I think this just goes to show how quickly the labor market has deteriorated, that, as states have started to encourage people to, stay home, businesses have shut down, and people are filing for claims at an extraordinary rate. And then the next slide actually summarizes sort of what is going on across various states. And so the states over, here you can see states with the 5 highest ratios. This is unemployment insurance claims relative to their labor forces. So you can kind of scale what's going on in the state by how big the state is. And a lot of the states that have been hardest hit are states that are very dependent on the tourism industry, like Hawaii, and also states where there have been a lot of cases of coronavirus or that began to shut down their states earlier. And then the states with the fewest claims here are ones where there have either been, fewer cases of the virus, or are places where they started to shut down economic activity later. And you can see Washington is somewhere in the middle. Actually, I was surprised that it wasn't higher given how early a lot of the activity was of the virus, but I think it, the state did shut down pretty quickly, and also because of its industrial mix, it's kind of somewhere in the middle in terms of what's going on in the labor market there. So yeah.
Well, next question, I think you've kind of keyed up on this slide, is with most recessions, what we're typically seeing is most recessions, the impact is on high school or lower income workers, right? And I kind of interrupted you here, I think a little early, premature, but after this slide, one of the things I'm hoping you can talk a bit about is how is the labor market, how are jobs tied to skill level, education, race, those sorts of stories that we're hearing on the national news?
Yeah, I can definitely get into that. So this let me just give you a little preview of this slide, which just is to say that or past recessions. So you can see that during the Great Recession, which is here, the unemployment rate shot up to about 10%. Now, we have data through March, and you can see that the unemployment rate did go up, about half a percentage point, a little over last month. But now, based on the number of unemployment insurance claims that have been filed, most analysts think that the unemployment rate in April, when we're going to get that number next week, will be like somewhere in the neighborhood of between like 12 and 16%. And it's true that, you know, unemployment, it's not sort of equally spread across the population. So this is something that my work has focused on quite a lot recently. This chart shows unemployment rates and how they differ by race and ethnicity. And so you can see this has been a trend that's been very stable, you know, over the last 30 or 40 years at least, from which we have good data, right? The African Americans and Hispanics have, you know, considerably higher unemployment rates than do non-Hispanic whites. And also it's a lot more cyclical. So typically when the economy is doing poorly, the unemployment rates of Blacks and Hispanics rise more quickly than that of whites and faster. And then likewise, it comes down more quickly as the economy starts to improve. So actually, it's hard to believe, but just a few months ago, we were talking about how great it was that the expansion had gone on for so long, because it was really resulting in substantial improvement in the unemployment rates of Blacks and Hispanics, and now that's starting to unwind. And you can basically, I realize the colors of this graph aren't that great, but you can see that the increases in unemployment last month for Blacks and Hispanics, and even Asians actually, was much larger than that of whites. And what we would expect to see in the coming months is, you know, a continuation of this trend. And some of that has to do with the fact that Black and Hispanic workers tend to work in more cyclical industries. I think it'll be interesting to see what happens this time, because some industries that hire a lot of low-skilled workers are actually, you know, need their workers to stay. So for instance, we see, you know, workers continuing to work in grocery stores, in meat processing plants, things like that, in agriculture. But on the other hand, workers in leisure and hospitality, you know, have been broadly laid off. So you can see actually this chart shows also shows the unemployment rate, and it's kind of a similar pattern. So the unemployment rate for people with a college degree is lower than that for people with a high school degree and less, or some college. And it's also more, you know, for the lower skilled workers, it's much more cyclical. And you can see that they've already seen much bigger increases in their unemployment rates than have students with people who have got a college degree or more. So I think, unfortunately, you know, as is the case in, you know, most recessions, it is low-skilled workers, workers of color, who tend to suffer the highest unemployment rates. Their unemployment rates are more cyclical, and that seems to already be the case, that we can sort of see the beginnings of that now.
So I don't know if I have or how I'm going to phrase this specific question, because there's a lot going on. I mean, literally this week, with these conversations of states opening up and declaring more business open. Simultaneously, you have some employers coming back saying they're going to have a hard time bringing workers back to the labor force because of the unemployment insurance benefits that low-wage workers are now getting. They're now making more money on unemployment. You have the federal government. Mitch McConnell made statements about not wanting to provide states resources to cover unemployment compensation. What's this? How do you untangle that story?
Right. So that's a lot. I think I can focus first on sort of this trade-off between sort of the unemployment insurance and work, and what those incentives are, and then we could talk about the situation of the states afterwards. So, you know, the unemployment insurance expansion that was passed in, as part of the CARES Act was actually a really substantial increase in the program. So it increased who is eligible to receive benefits. Typically, workers, say in the gig economy, self-employed workers, they're not eligible. It also allowed people who have to stay home to take care of their kids because they no longer have childcare to file for unemployment insurance claims. And so there was a real broadening of who, also if you were sick, say with the coronavirus, or had to take care of someone who was sick, you could file for unemployment insurance claims. So there is a real, there was a real expansion of the program. And then, as you mentioned, on top of that, they also made it so that people received more money. So now the weekly wage, whatever you're getting from the state, the federal government is topping it up by $600, and that's essentially equivalent to about a $15 an hour minimum wage, which is more than the minimum wage in a lot of states, including Washington State, where I think it's like 12 maybe. So I think that, this does create an interesting incentive. So for workers who were sort of temporarily laid off and just furloughed from their jobs, if their employer calls them back to work, they actually are not eligible for unemployment insurance any longer. But if they were fired, then, they don't have to go back to work when their employer reopens. And, I think that in that case, the employer does have to be able to pay a competitive wage to bring these people back. So I think the reason that the benefit was set so high is because we're in a time where, for the most part, we actually don't want people working. We want people self-quarantining as part of our strategy for defeating the virus. And so that's sort of the incentive that they were trying to set up when they set the pay so high. And if there are jobs that we really want people to be doing now, I think an interesting question, that we should all think about as economists is, how can we correctly get the incentives right? So a lot of times the jobs that we want people doing now are not particularly high paid jobs. So there are things like working in grocery stores, driving trucks, working in warehouses, working in meatpacking plants. And the question is whether, given the conditions that we're facing today and the risks those workers are taking, whether those should really be jobs that are paid the minimum wage right now. Or maybe we should think about paying these workers some hazard pay as a way to, make more sense for them to come back to work. And I think there is a question of whether, obviously employers who, if they can increase their prices, they can, because they're offering a valuable service, they could pay the workers more, or if there really are jobs that the federal government deems necessary or state governments deem necessary, the resources could be paid for that way. So I do think it's an interesting question for economists, which is, how do we get people who we want to stay home and self-quarantine to stay home, while at the same time encouraging people who we need to work to fill these positions that we are deeming essential.
Well, and it seems like a lot of the dynamic of, like you said, the jobs that might not have been desirable are being filled by lower income workers, minorities, because you are hearing a lot of the meat packing, pork processing plants forcing people back into work, or now even shutting down because the virus has spread throughout so much of their workforce. So it is an interesting dynamic of people that are typically those that didn't get these huge gains in the labor market are now the ones that are being pushed to put their lives kind of at stake for what is now essential. So how can you get their wages higher, right? Is it the federal, or is it state government support? Is it the private sector doing it?
Right. I think the idea that we would continue to ask workers to do work that is now like demonstrably more dangerous at the same wage we were asking them to do it, 8 weeks ago. As an economist, that doesn't make sense. Or no, as a person, it's a moral issue too.
Definitely not, right? You would think the market would correct some of that, but I don't know if it will so very quickly. Yeah. So with unemployment, that $600 topper, what are the implications now? One, of the added spending to provide the unemployment insurance, which is coming out of the state budgets, but then also, the decline in state tax revenue collection. Washington State, we do not have an income tax. We're 100% sales tax. You, you,
I
you
didn't
read
know that.
my question, I think, right? And a follow-up question, just so you know, is how is this going to implicate or affect some of these longer run programs that you had people promoting, right? Free community college, right? While state was looking at a program to provide free higher education to community college or even four-year schools, right? How does this change our priorities down the road, right? So that'll be my follow-up question.
Yeah. So it's true that, states are in a very precarious position. And I think if you asked my colleagues at Brookings what's like the number one thing we should be doing for the economy right now, I'm pretty sure they would say it's getting more aid to states. So I have a graph. This is the graph. So actually, this will be particularly apropos for Washington State. So this focuses on state and local excise tax receipts, which is basically like sales taxes. It's mostly sales taxes. And what we do is we say, let's just normalize everything. So this is basically the receipts over different business cycles. And so they just say, let's say the peak of the business cycle when the economy's the best, we just made that 100. What happens? So usually you have the tax receipts are, for the most part, growing a little bit in the years leading up to the peak. And then during the recession, actually in your average recession, this is kind of your average recession over all post-war recessions. Actually, sales taxes across states are pretty flat. The big hit usually comes in property taxes. But in the Great Recession, there was a really significant cut to sales taxes. And I think we would expect to see even a much bigger decline. So this is basically like saying that the level of sales taxes, even 2 years after the peak, the cyclical peak. So this is like, now we're talking about, late 2010, early 2011, sales tax receipts during the Great Recession on average for states were about 93% of what they had been at the peak. And I think we can expect to see a much bigger decline now because we have literally told people, don't go shopping. And so, except for, necessities, groceries, things like that. A lot of the sales tax receipts that might have come from restaurants and all stores, clothing, shopping, things like that, right? There's none of that activity is going down. So this is just showing that states are losing a lot of revenue. Another issue is actually that the federal government put off the date by which people have to file their taxes, their tax returns for 2019. And a lot of states just piggyback on the federal system in terms of their own state tax returns. And so most states have also put off filing of taxes until the summer. But actually, states get a lot of revenue from those tax returns. And so they were really counting in April on getting a big influx of funds that they're now not going to get until the summer. And so especially over the next few months, the states are really going to have a lot less income than they would expect it, not only because of the fall in sales taxes, but also because they're not getting this injection of income taxes that they expected. And so I think we really need to be thinking about how we can best provide more resources to state and local governments because they provide a lot of critical services. And one of the reasons I think that actually the recovery from the Great Recession was so weak was because state and local governments took such a hit and their spending remained anemic and their hiring remained anemic for many years. And that actually was a big drag on the overall economy. I think that, the unemployment insurance system is a perfect example of this because actually a lot of states ended up running a deficit in their unemployment insurance systems. They had to borrow money, which actually for unemployment insurance, they're allowed to do. In order to fund those systems, they cut back benefits a lot in order to try to refund those systems. So these extra benefits, extra weeks of pay, the $600, that's actually being paid by the federal government. But the states are still experiencing very strong demand just for their basic services. And those programs are in trouble and the states don't have a lot of revenue to cover it.
Gotta unmute myself. So in Washington State, given we are at 100, I mean, sales tax, property tax is our big bulk. What do you see this recovery being, this very quick recovery and allowing states to gather some of this revenue back? Or are you going to see more of a multiplier effect in all of a sudden states are going to slow to recover, there's going to be cuts to education or other essential services, and it's going to be like a Great Recession type recovery where state and local employment fell and probably didn't recover for what, 5-6 years after it?
Yeah. Actually, I did a talk on state and local government finance last spring, and basically employment had basically just reached its pre-recession levels. That was 8 years later. So 8 years after the trough.
Right.
So I think, I don't know the answer to that for sure.
No, I don't.
I mean, I think that, I think there will be a substantial rebound in activity when states start to loosen up. And so I do, expect to see, pretty big growth numbers when states allow people to start going out again. I mean, some of the spending that would have taken place is probably not going to take place. People, dinners that you didn't eat out, over the past few months, you might make up some of those, but not all of them. Trips that you didn't take could be taken only over a very long time. You're not going to just go out and take them all. So in that sense, I think, some people really are going to have lower income because they've lost their jobs and the unemployment insurance doesn't make up for it, so I think that, or they're not eligible for the unemployment insurance. So, I think that it's not going to be I think we'll see some snapback just because people are going to get out and start when we're able to get out. But I do think that a lot of the, how this is going to trickle through state and local governments is going to depend on whether the federal government gets its act together and provides some substantial relief to state and local governments. So I have a colleague who, something that was done in the past was that states were, the federal government increased the reimbursement rate for states, so for Medicaid, and so that's a great way to pump money into states, and one of my colleagues is advocating something like that. So I think there are a number of things that we could be doing. I think, the support to businesses, if that money really goes to small businesses and communities and helps to keep them afloat and helps them to retain their workers, I think that would substantially improve the likelihood that we would see a snapback. If lots of businesses close and, workers are detached from their jobs, then I think that really decreases the likelihood that we'll see a fast snapback.
So then, pulling on some of your experience from the Treasury and the Federal Reserve, does the fact that, not that the Great Recession being relatively in the near past is a good thing, but learning from our policy efforts following the Great Recession, both from the federal government and Federal Reserve, is that helping us in our response? The CARES Act, from proposal to being passed, what was it, 2 to 3, very quick, 2 to 3 weeks. Whereas the American Reinvestment and Recovery Act took a presidential election and, considerable time. So how are you seeing the policy efforts in the Great Recession help us in our stabilization and then hopefully recovery efforts once we start opening back up?
Yeah. Yes, that's a great question. So I think there is no doubt that the Federal Reserve learned a lot. They acted remarkably quickly. And, they have done a lot of thinking over the last decade about what worked, what didn't work. There was actually I have to tout Brookings here. There was a great Brookings event, not this past fall, but the fall before, that was precisely about what lessons did we learn from the Great Recession and, and the financial crisis, more specifically, about how to fight the financial crisis. And I think it's very clear with the alacrity that the Federal Reserve acted. They cut rates to zero right away, because I think one of the lessons that came out of it was there's no sense in keeping your, the powder dry, as they say, no sense in keeping a little room to further lower when you don't have far to go. So they just lowered rates right away, and then they quickly set up these facilities. And I think another lesson that they learned was there were a lot of complaints in the Great Recession that the policies that they established focused more on big businesses and bailing out financial institutions than on, smaller businesses, the state, things like that. I think it is easier to ensure liquidity in capital markets, the treasury markets and money markets, than it is to provide loans to municipalities or to other, small businesses. But I think that the Fed realized they had to try. And so they've done things in this, in response to this crisis that they did not do in response to the Great Recession. And I think a lot of that was learning about, what works and also what works politically, both. And I think one of the things that Powell has said that he's very happy about this time, Chair Powell of the Federal Reserve, is that they worked very closely this time with the Treasury Department. So the Fed, it is an independent agency. They're not elected. The members are nominated by the president, so they're not completely unaccountable, but they're not elected directly. And so I think he felt very strongly that if the Fed took actions like, say, the facility for small businesses and municipal bond markets, that had to be done in conjunction with the Treasury Department because it gave it more political legitimacy. And so I think that, so he's very happy with the way that unfolded. And I think it's to the credit of the Treasury Department that they also worked so quickly and Congress to make these facilities feasible. So I think that is a clear example of some really significant learning, and in a sense, the benefit of having had the Great Recession so recently, that there are so many of the players who, were involved with that crisis, involved in this one. I mean, I think Congress also did act very quickly this time, but I'm not sure they learned all the lessons. I think it is impressive how they expanded the unemployment insurance. There's still a lot of problems with that system because the state systems are old. Lots of people actually, even like a lot of the new workers who are eligible, like the gig workers, they actually are not yet able to even apply for benefits in over half the states because the state systems just can't accommodate it yet. So I think there's a lot we need to do to figure out how to get federal resources to people faster. So, also using the tax system to get out the stimulus checks. Lots of people who really need the money don't file taxes or they don't do direct deposit. And it's been very, very difficult to get this money out to people. So I think there's still lessons we need to learn from what's going on now, and the support to state and local governments. I mean, the fact that we're still haggling over that, I think, shows a distinct lack of understanding of what happened after the Great Recession.
Yeah, that was my initial hope was, wow, they're acting very quickly. We're not going to get this, hold states accountable. They need to fund their own resources. And now you're hearing federal funding conditional on sanctuary city decisions, very much unrelated to the economic crisis that's unfolding in front of us. So I'm going to open it up to questions. I do have a couple that have come in. So the first question is Juliana. I'm going to unmute you. Feel free to start your video and ask Stephanie a question.
Yeah, so I was just wondering, with regards to college students and unemployment, do you see that being like a really big issue this summer, or do you feel like enough places are going to open back up and there's going to be like remote options so that it won't be like that big of a problem?
I think it really, I don't know. I think it really depends on the type of position you're looking for. I mean, it is the case, say, at Brookings, we actually are, planning to continue to hire our interns and our research assistants, and we're setting things up so that people can work remotely. We actually just brought in a new research assistant and a new intern within the last week. So I think a lot of businesses that are still operating, that are set up for, telework, I suspect they will try to continue to bring in people, college students to work. You guys are valuable employees who really help businesses to achieve their goals. And so I think, to the extent possible, businesses will want to continue to bring in students. I think the problem is just that depending on the type of job you're looking for, it's true that a lot of, employers where there's, where the job requires substantial interaction, those, businesses have just closed. And so I do think, there's probably some set of jobs that are not going to be filled this summer, but it's hard for me to say, like, in your area, what the shares of those are.
Yeah, I've heard of some companies are doing virtual internships. I think Starbucks is running a virtual internship program. It'll be interesting to study the effectiveness of some of these programs, which I think is going to align with and someone just said Boeing as well is going to run a virtual internship program. So it seems like there's going to be a lot of experimenting with how to get these workers in, as people, I would imagine, are looking at more and more retirement as a potential option. Do you have a follow-up question, Juliana, or was that good? Good. Okay. So Callum, you are up next. I'm unmuting you. Go ahead and fire away to Stephanie.
Hello. Question I have is that currently companies are realizing more employees are more productive at home because they work longer hours than going into like an office space. Do you believe that labor markets would shift towards those benefiting in like a rural part where they can work remotely, or would they still benefit those who are in an office space?
I think that this is going to bring about a pretty substantial change in how businesses think about telework. I think I can say at Brookings, we're already having conversations about what it would look like when we go back to the office full time. And I know I've heard other organizations are doing the same. There's also I've heard some airlines have really reduced their projections for business travel going forward, because they think as people have become a lot more used to using, programs like Zoom, that more and more businesses will choose to do their work online, through video conferencing than having people actually travel. And so I think I would not be surprised to see an evolution of the labor force. I think it's not like a change in, like a complete change, but I think it's like expediting a trend that we were already on that was promoting telework, people being out of the office for at least part of the week and working from remote locations. So I would expect all of those trends to accelerate in light of the experience that people are gaining with these remote technologies now.
All right. That's it. Thank you.
Mm-hmm.
So good question. So I think that's one of the big questions our students have is, as they're looking at college majors and this shift in potential work environments and all these other dynamics, what advice do you have for them on choosing majors, choosing careers? What drove you into economics? Is that, right? I think economics in a recession is not a bad thing to study, but what drove you into that career? What do you see changing in these industries over time?
So they're kind of two different questions, I think, there. Like, one is kind of what's the occupational mix going forward? So what should students study? And, and then a second question about, like, should you study economics, and why did I study economics? And I think those are kind of, I'm going to split those up, I think. So, I think that this is actually not really my area of expertise in terms of what occupation, kind of what are the fast growing occupations. There's actually like a whole website that the Bureau of Labor Statistics has devoted to like what the fastest growing occupations are going to be over the next 10 years, the next 20 years. And they have various ways that they, project what they think the industrial and occupational mix is. And that's really where you should go, because this is not my area of expertise. That said, there's clearly very strong demand for technical skills, for computer programming, for people who are good writers. I'm always surprised at how few people actually have that skill, and it's really important. So I think, in a sense, getting a good, all-around education, being able to write, being able to think critically, those are the types of skills that employers value, you know, regardless of whatever, you know, your specific niche is. And I think that's, you know, the other piece of advice that I give people is to, you know, when you have an area that you are interested in, to really focus on what are your specific set of skills that you can bring to that. And so, and this actually does start to get into the second question you raised about, you know, my own interest in economics and how I got into it. And, you know, I think for me, I was always very interested in like economic and social policy. And I, you know, realized that economics, I was good at math. And so I was sort of like, oh, I'm interested in economic social policy. I'm good at math. Lots of people don't like to do math. So that seemed like a good special niche. And I was very interested in statistics. I really liked it a lot. And, you know, so I think that sort of led me to do, you know, economics as opposed to a field where I could study policy that was more qualitative, because I realized that I had this specific skill. And then I think, you know, when I was in graduate school, I was thinking a lot about whether I should go into academia or whether I wanted to be in a more policy-oriented policy-oriented position. And I think that, you know, for me, my particular interest in policy, you know, kind of made me choose that type of environment as opposed to a more academic environment. And I think also, you know, one of the things that I found over time is that I'm pretty good at explaining economics to people. And so that was like another, you know, skill that I wanted to be able to capitalize on. So I think, you know, in whatever you do, having a basic solid set of analytic skills, writing skills, basic computational skills, and then figuring out what your particular interests are and what's the unique thing that you bring to it. That I think are all crucial elements to trying to figure out what to study and what jobs to pursue.
And I think this is going to tie in well with the next question I have from Sloan. Let's see if I can, there, she's unmuted. So go ahead, Sloan, go ahead and ask the question.
A possible question that I have is, how do you think this will impact the amount of people seeking higher education or possibly going into skills trades because of this epidemic?
Yep. Okay. That's a really interesting question. I've been thinking a lot about this recently. So the normal pattern you see in a recession is people tend to go back to school. So when there aren't really good jobs, this is a time when the opportunity cost of being in school is low. And we tend to see a bump up in enrollments in community colleges and four-year, you know, colleges, master's programs. So and people actually stay in high school longer, so the dropout rate actually goes down. So the thing that's so that's what I would normally say. I think the thing that's a little unusual here is how the online learning is going to play out. So I do think it's a question of like, are schools going to open in person in the fall? And if not, how will people view home education? And will people want to pay to be studying at home? And so I think there's a bit of a trade-off. There's just this unknown element where it isn't clear to me that the normal cyclical pattern, like that people get more education in recessions, I'm not sure that that's going to hold this time, because I do think there's this competing issue around the, you know, how people will feel about doing the online education. I mean, it's possible people are more used to it. And so, you know, you could see even a bigger bump because people could also start to combine online education with work more. You know, that they'll feel more comfortable doing schooling in the evenings or, you know, alternative hours and combining that with work. So it actually could play out in a lot of different ways, but I think that there's a lot more uncertainty about how people are going to, you know, the role that education is going to play kind of over the next year or so getting us through this than it would normally. You had a second question, but I've already forgotten it. Hello?
I think I have to unmute her. Hold on.
Okay.
Let me get her back on.
Sorry.
No, you're good. There you go. I think there we go.
Thank you. I'm not quite sure about that either, actually, but another possible question that I have is, how do you think this will impact like the competition rate of people coming out of college being employed if there are more people that are seeking higher education?
Right. Okay, so I think, if more people stay in higher education, then, all else equal, it's easier for people who do try to find jobs to, obtain them. I think the general lessons that economists have learned by studying there's actually a whole school of literature of what happens when you graduate in a recession. And I think what people generally find is that it can be hard for people to get their first job, harder than obviously if you're, graduating into a really hot labor market. And sometimes the jobs you get, the first couple, are less good matches for you. So, you have your ideal job and you can't get that one. You take that one, one that's a little less good. And, but what they typically find is that over time, things sort themselves out. So people, especially college graduates, after a number of years, they're typically having as high employment rates and not exactly as high wages, but pretty similar wages to what they would have earned if they graduated into a regular time. So I myself actually graduated in the recession of 1990. It was a rocky start, but things play out over time. And so I think it can be rough at the beginning, but the evidence suggests that over time, most people, are end up pretty much where they would have. It just takes them longer to get there.
Yeah, I'm 2 for 2. I graduated following the recession of 99, 2000, or 2001 when there was a hiring freeze. And then 2009 was not a good time to come out to the job market out of graduate school. So
No.
I can attest, it tends to be your first kind of go around gets a little bit tough, but then you eventually get into the right spot. The online education is going to be really interesting. I would actually be more worried if I was a university that focused 100% online, because you just had the biggest capital investment in online education for every university across this country. So if you're Southern New Hampshire University, University of Phoenix, that focus heavily on online, you're going to be really worried that there's going to be a lot more competition in that space going forward. So
that's a very interesting point. Yep.
It'll be interesting to see how this dynamic plays out. New York Times, the president at Brown University, I don't know if you saw it, she just posted, where we got to get students back to campus. The students want to be on campus, and they need to be on campus, I think, for everyone's health in a weird way. I'm going to open, Nathaniel's got a question. I'm going to unmute you. Go ahead and fire away.
Hi, can you guys hear me?
Yep.
Perfect. Okay. So I have one question for you, Stephanie, and that is, do you think that COVID-19 is rapidly accelerating the demand for automation in certain sectors of the economy?
That's an
I'm thinking
question.
more like restaurants and perhaps anywhere where automation would be super useful during times like these.
Yeah, I think it must be. It's only been like 7 or 8 weeks since, the economy's really started to shut down. But I think, I think, again, it kind of goes back to the answer I gave before. I think this is going to accelerate trends that we already were seeing. So, for instance, a lot, over the recent years, we've started to see a lot greater automation within warehousing. Amazon has been experimenting with stores where you can just, there are no cashiers, you just check out yourself. And restaurants have been playing around with, using iPads where you just order on the iPad. So I think places have already been experimenting with that. And my guess is that in some of these, occupations that is going to accelerate.
Yeah, I think you're seeing it. I think I choose to attend, or when I'm at the grocery store, when I go every 2 weeks, I would choose the self kiosks.
Definitely.
Right.
Yep.
And
It's faster, more efficient.
Well, and at this point, safer, it seems like. Next question, I think, ties in actually with one of my kind of theories, or one of my things I think we should look at. Woody's got a micro question, so I'll unmute you here as you're getting unmuted. One of the things in the state of Washington, we actually don't charge sales tax on personal care. So when you go to the barber or you go to the salon, there's no sales tax on those items. We also don't charge sales tax on cell or internet services. So I'm thinking one way states could boost revenues about a 25% sales tax on haircuts, as I am certainly evident of, just for like the first 6 months. All right, Woody, go ahead.
Yeah, so my question is, would you kind of see a consumption cycle for specific items such as haircuts that have been put on pause, where there would be a very high increase and like a demand spike for that, followed by like a 2-month lull and like nobody requesting a haircut, and then another spike, and you kind of see cycles like that in specific industries?
You definitely see that in the data, that, like say after snowstorms, right? So you see, like, for instance, leading up to a snowstorm, people are, stocking up on supplies that they think they need to withstand the storm. We saw that already at the beginning of, COVID-19, when the shelter in place, requests started to come in. People are stocking up on food and, things like that, not shovels, but, and then, when the incident is over in the data, when a storm is over, then you see like a big bump up in, things like going to restaurants and other, bars, and leisure and hospitality gets a huge boost in the data and consumption. So the thing I haven't really noticed is this kind of echo that you're talking about, whether you then see another lull and another boom, and you could imagine that going on and dissipating over time. I don't recall ever particularly having seen in the data, but I wouldn't be surprised if there were a little of that. I think, the big thing is that there certainly are going to be some services for which there's just really, really strong demand, and some goods, once people are able to leave their houses. And actually, I think one of the interesting questions is what's going to happen to prices. So, we've had really low inflation in recent years, and I think it is sort of an interesting question of whether, I wouldn't expect to see like a whole big inflationary cycle, but I could imagine for certain goods and services, once the economy does start to open up, that we could see actually a bit of inflation there. I think the Federal Reserve would welcome at this point.
Yeah, getting inflation up to 2-3%, and with projected deficits, I think a little bit of inflation might not be a bad idea, getting it from that 1% up to 2.5-3%. I'm going to open up the last question to Gina. She has a question, and then when Stephanie is finished, I'm going to hopefully get and ask those that are looking at graduate school in economics just to stay on for a couple questions for Stephanie. So I think there's a handful of you that I know are looking at graduate school, so I'll have everyone kind of leave the meeting except for those that are considering grad school. So Gina, you are up. Let me unmute you. Go for it.
Okay. Hi. So something that I've been thinking throughout all of this is that like one of the benefits of people working in an office or going to school on campus and having that in-person interaction is the diversity of thought and how that encourages and promotes innovation. And how do you think that that will affect us long-term, and as well as like how will that social change affect the economy in the long term?
Yeah. So I think every, business I think there is a trade-off. I mean, I think people are getting a lot better at sharing their ideas and working together online, but I agree that there's just a lot of like that cooler, talk in businesses, which is really productive. You're just sitting around the lunch table, chatting with your colleagues, and a lot of productive stuff can come out of that. Actually, at Brookings, we've started to have like online lunches that people can just join because we were missing having that regular interaction. And that's where we would normally talk about, what the hell do we think is going on? And so we wanted to recreate and we'd learn stuff from each other and come up with ideas and for papers and things. So I think, we've actually tried to recreate that. So I think each business is really going to have to decide whether, the teleworking and whether full-time teleworking sort of works for them, and whether they can recreate some of that collaboration, because I think a lot of it is informal. And so the question is, can you, a meeting, I think we're learning we can do that online. But, what the loss is to these more informal interactions, I think we don't know the cost of that yet. And I think businesses are really going to have to decide based on their own models how costly that is to them. And I suspect for certain businesses, they really are, even after this, going to want people in the office at least part of the time because of the, just creativity and productivity it generates. I think also actually, people have different needs. There is definitely like a psychological component to working from home. And, for some people, I think it really works. And, for other people, it doesn't work. They really, feed off of having colleagues around, seeing different people, being able to bounce ideas off of people. And I could also imagine a lot of, that people will start to sort themselves differently across, workplaces. I might say, oh, I don't want to be at a place where everyone is teleworking because for me, I value the interaction, whereas other people might be happy to be in that environment and prefer it. And so I could actually imagine quite a bit of sorting across businesses, depending on where they end up on the spectrum of telework versus not telework, depending on, personal preference as well.
I think Gina gave me a good question for my final exam, is that ties into, in my intermediate macro, we introduced kind of Romer's model of economic growth that relies on innovation and ideas, the whole increase in returns to scale of ideas. And certainly you have to, if people aren't coming together to form, these key questions and how to answer them, is that going to have a bigger long run impact on economic growth for those reasons?
Yeah. Yeah, it's kind of weird because it's like an undoing of the agglomeration, that we think is so productive. So like, what do we think about that? It's an interesting question.
And I think that's a great question because I think that's absolutely one of the, when 5-10 years down the road, and we look at some of the long run consequences of this shutdown and the transformation of business, how has it impacted interaction and the rate at which innovation was occurring? It'll be interesting to trace that out. So yeah. That was a good question, Gina. So while everyone's still on, I definitely want to thank Stephanie for her time. We really, really appreciate it. I have your address from the other Stephanie. So we will send you some stuff, some Gonzaga stuff as well. So we cool. Are incredibly grateful for you spending an hour. I think I heard a little bit of your son's piano in the background.
Yep.
No worries. And so it was incredibly thankful of you. Oh, and there goes Gina's phone.
Sorry.
And so I will let everyone quickly sign off. If you are someone that's thinking of graduate school in economics, feel free to hang around. I think I can convince Stephanie for 5 more minutes to talk about grad school in economics.
Yep.
And we're getting
Thanks, everyone.
Thank yous coming in. They're thanking me. I didn't have to do anything. So. Okay, we're getting down to a few. And then when we get down to just the grad school and maybe some faculty might stick around, I'll just unmute everyone and we will, let's see here, stop your screen share and get everyone out of here. So yeah, it'll be interesting to see. And I'm actually going to stop the recording.